What's going on, guys? It's your boy Trillionaire Mac. Welcome to part two of this short video series. I don't think I'll need more than two parts, so we should be able to wrap everything up in this video right here. But I'm basically providing you guys with a blueprint of how retail traders think versus how institutions think, so you can start to think like an institution and stop trading support and resistance, breakout strategies, retest strategies. They're profitable a percentage of the time, but you're just not going to be profitable long term with taking those types of trades. Now, you can develop a keen sense of which trades are true and which trades are false, and then you can get better at it for sure. Or you can just trade like the institutions and really just take advantage of price. All right. So this is just my personal opinion, my recommendation for you guys. I used to be a support and resistance trader. I've been a breakout trader. I've been a break and a retest trader within the trend. And I've just realized over time, especially talking to someone who has been a part of an institution, I just realized that, the banks really do instigate moves like that just to collect liquidity. And I don't want you guys to be on the wrong side of the fence. All right. So this is part two. Make sure you guys click that thumbs up button as well as the subscribe button. Also hit that bell notification icon to be updated whenever I upload a new video. All right. I really want you guys to join the family. And yeah, just continue to increase your knowledge about the foreign exchange market. All right. First link in the description is my Telegram channel where I do send all of my trades. As you guys can see, we have, wow, it looks like a lot of people actually got kicked out because they probably forwarded a trade, but they'll be back next week. But we do have over 5,000 subscribers a part of this Telegram channel. I really want you guys to take advantage of it. Just don't forward any messages out or you will be kicked out and the bot will put you in the week after, which means you'll miss all the trades for the remainder of the week. So don't do that. It's not a good idea, but let's get back into it. So within this area right here, we can see how, if you haven't watched part one of this series, go watch part one first because I'm not really going to explain everything that's here. I'm just going to dive right into it. So go watch part one if you did not watch part one and then come back to part two. All right, cool. So now I'm going to go ahead and get started. So what banks do is once price pushes up here, in order to instigate retail traders to do something, okay, they're going to place a large sell order right here. Now remember, because banks trade with so much money, they actually don't use stop losses. So ignore this stop loss area right here because if price were to push to the upside, their orders are so large to where, there would be like their stop loss would not be able to absorb all of their orders and close it. Therefore, they just don't trade with it, right? So what they do is they instigate sells to take place. Anytime you see a large push to the downside or the upside, understand that banks are doing that. Okay, so we talked about what retail traders are doing within this area. Now we're going to talk about what the banks are doing in this area. So what banks do is in order to push price down to break a level of support, all right, collect liquidity on equal lows, as well as instigate retail traders to act within the market, they're going to place a large sell order at resistance. Okay, now sometimes what you'll see is if they don't have enough liquidity to place that large sell order, okay, what happens is they'll wait for price to, take out stop losses, okay, up here within this area, okay, and then they'll place that large order for price to push to the downside, okay, because remember, in order for banks to place a large number of sells, like for example 10,000 lots for a sell position, they need to absorb 10,000 lots within the market because the market is always 50% buyers and 50% sellers. If someone is placing a sell contract, someone else has to be placing a buy contract, okay, or there has to be liquidity in that area that absorbs a buy contract, whether it be stop loss, orders, or anything like that, right? So that's the psychology behind it. So banks will place a large sell order once they collect liquidity, a large sell order to push price to the downside. Okay, and then what they'll do is once they come down here, okay, and they take out anybody that was taking a buy position right here with their stops down here. Okay, also breakout traders, okay, are placing their orders right here, similar to what we talked about on the last episode. Okay, so there's liquidity down here for them as well as there are equal lows. Okay, so there's liquidity all within this area from others taking buy positions right here, putting their stop loss down there, looking for price to break this resistance. and right here as well. So there's a lot of liquidity within this area. So what they do is they'll take a large sell position at this resistance up here once they collect liquidity, push price down, and then what they'll do is they'll take the true buy position that they wanted to begin with. Okay, so it'll look something like this. And let's just move this a little bit to the upside. All right, so they'll take buy orders down here, okay, absorbing all the liquidity in order to take a very, very large buy position to push price to the upside. Once they push price to the upside, what happens is this order right here is now in drawdown, okay? So they have major profit from this trade, but then they're in drawdown on this trade right here. So what do? In order to, and really, let's move this down just a little bit, maybe like right here, just to make this a little bit more realistic. So it's more than likely going to look something like this. All right. So what they do is they then have to instigate sells up here, push price back to the downside, okay? So they instigate sells up there by doing the same thing they did here, except opposite, okay? Push price to the downside, all right, to close this order out, either in profit, a little bit in profit, break even, or for a little loss. Okay, so now this order right here has been closed because we see that we are back in profit on this order. Okay, cool. We're going to go ahead and close that order. And then what they do is they allow any order right here that wasn't filled, any buy position that wasn't filled, they allow that to get filled, and then they target wherever they're going to target. Okay, that is why this right here is the secret to why I trade order blocks. Right? This right here is the exact reason of why I trade order blocks. When you trade an order block, you're basically mitigating the bank's previous order for it, right? Because they're going to mitigate this order right here for a small loss, small profit, or around break even. Okay, but also they're going to fill any buy positions that were not filled from the liquidity within this area before allowing price to push to the upside. Right? This is exactly why trading order blocks work. Right here would be the order block. Okay, the last down candle before the initial move that decided to break structure. Right here. Right? Price retraces back down into the order block, and then that's when we look for our rule. That's when we use our rule of 3 and then use our 2-step process to take an entry within the order block area to know if it's valid or invalid. And then price shoots to the upside. Okay, so this is what it's all about. This is how the banks trade. All right. So I wish this. I hope this explanation. Not I wish. I hope this explanation was very, very easy for you guys to actually absorb. All right. Understand. I broke it down the simplest way possible without giving too much mentorship information to you guys. But with the information that I did give you, you guys will be able to hop on the charts and see this schematic take place over and over and over again. Right? So this is exactly how the banks move the market. Institutions, this is how they move the market. This isn't something that, this isn't something that is debatable. This is fact, right? So if you guys take advantage of institutional trading, okay, how I've taught my mentorship students to trade, how the types of trades that I send in Trillionaire Mac Trades, link is down in the description, first link, okay? This is exactly how we trade, which is why our trades are always high probability, okay, with a very, very tight stop loss. So normally we risk less than 15 pips on each and every trade, and normally our stop loss is between 5 and 10 pips, right? So just imagine being in this gold trade right here, risking about 20 pips, okay, and then targeting something like this, that's around a 44.52 risk reward ratio. Yes, we have done a trade like that for sure. All right. So if you guys want access to my trades, hit that first link in the description. While you're learning, while you're continuing to, while you're continuing to, actually, I'm going to have to take this call. So what I'm going to do is I'm going to go ahead and wrap this video up here, but I will release another video after this one. Peace out, guys. Make sure you subscribe. Bye.